Sorry, can you guys hear me?
Yes.
Okay, better.
Perfect.
All right, let's back up. This is Microtick. We're a brand new chain. We launched in the end of July. It's at www.microtick.com. And what we'd like to do is we had some requests on Telegram to lead people through kind of the mechanics of how the marketplace works and the way that we're trying to achieve price discovery. Microtick is an oracle, but we're trying to do more than that. We're trying to bring price discovery on chain in a unique way that is not, it's comparable in certain ways with respect to how automated market makers work. It's also comparable to the way oracle pools with schelling point price discovery works. And so what I'd like to do is walk through some of that with this presentation. So my name is Mark Jackson. The best way to contact me is on Telegram, Microtick Telegram, and I assume that most of you are members of that. You can also jump on Discord. So any conversation about price discovery starts with the efficient market hypothesis. And I don't want to bore everybody, but it is important to understand that, at least in theory, liquid markets are assumed to reflect all relevant information at any given time. And even if that's not, even if you're one of the dissenters of that hypothesis, it's still probably true that the more liquidity you have in a market, the better your price discovery function is going to be. And so the questions that we're trying to address with Microtick are, number one, how do we generate more liquidity for assets that either are not liquidly traded, or, like, for example, indices or things that cannot be traded, maybe just categories of things, or is there a way that we can do this type of price discovery leveraging schelling points on chain and therefore kill two birds with one stone and maybe improve the way fintech works in the process? So whether we've done that or not remains to be seen. Microtick is still very much in a test phase, but here we go. We're going to talk a little bit about how traditional price discovery works. So on the left there, you see a traditional order book with bids and asks. The smallest orders are on the inside of the spread. I've illustrated that in yellow. And you can see that the problem that you have with blockchains is we're sampling prices as they oscillate in the real world. And the problem is that the order book is unstable. It's the inside bids and asks are the smallest orders, and they're the easiest matched. And so your price moves quite a bit with respect to short time durations. And that really doesn't lend itself very well to conventional, or to, to blockchain price discovery. So when we try to, you have several problems with that. Matching, since it's occurring at a centralized location, you have issues with price dissemination as it goes across the network. Order flow all has to converge at that point, which leads to issues with front running and high frequency trading on the order book itself. But then as blocks occur at unpredictable times in different locations, your observer may, even if you trust the observer and the observer is using a trusted path and authenticating its price discovery, it still can have issues because it may sample at the high or the low as the price fluctuates. So I've tried to illustrate that with this next slide. We've got a data collection process, whether it's an oracle pool or some other schelling point process. The data points tend to converge or collect at the center of the average, illustrated on the left there with the blue quotes, but you have outliers. And so even if your trusted oracle is sampling prices and it's doing a good job of it, you still can get a process that leads to slashing conditions, even for prices that were obtained in a reputable, trustworthy manner, illustrated by the prices in red. It's just because the blocks happened to occur right at the point where the price was at a maximum or a minimum with respect to the epoch. And the epoch is illustrated in green. So in this case, we've got 6 blocks leading up to the point where the epoch ends. And at that point, we take the average, that's your price for the next epoch, and you slash the 2 that are in red, but those 2 in red didn't do anything wrong. the price was actually at that point during the discovery process. And so it's not really a good way, it's not really a good match. We need to improve on that. And we think we've done a good job of that with Microtick. And we're going to go into that a little bit more after we cover automated market makers. So I'm sure a lot of you guys are familiar with automated market makers, Uniswap. On the Cosmos side, we've got Thorchain and various other players in the space. They're basically smart contract based. They've got pools of token liquidity. And they use bonding curve math to arrive at a market maker process that can work on chain. And it's very capable in the DeFi space. And it also has the additional advantage where you can serve an oracle function for other dApps. The one disadvantage is that it uses tokenization. So that's a requirement. You can't represent assets that are not tokenized or that can't be traded. And that's where I think Microtick differs a little bit, is that we want to escape from the bounds of tokenization and start to represent prices as decoupled from the actual trading of the underlying. So here's the comparison slide. We've got the similarities are that it is smart contract based. We've got a chain operational, it's Cosmos SDK based, but it'd work on other types of smart contract based chains. The Microtick does not require tokenization, as I mentioned. It is similar to the decentralized Oracle pools, the second to last slide that I just showed you. It has a Schelling point shape of the order book with the quotes centered at the average, and the best prices are at the edges. It does not use epochs, slashing, or reputation. Instead, we're standardizing assertions using option-based pricing. And the reason that we do that, I'll cover in the upcoming slides. But the one thing that I really want to point out is that it's very easy to combine liquidity cross-chain. So if we had a chain running on Cosmos SDK and then maybe one running on, I don't know, Ethereum, up and coming Cardano, various chains could all have, if they're using the same backing token, all we have to do is exchange 2 data points per block. And by doing that, we can generate a cross-chain consensus price and gain the advantages of all the liquidity on all the various markets just by trading those 2 data points. So it's very easy to design a cross-chain implementation that benefits from liquidity across all the chains. It's not meant to be chain specific. Similar to automated market makers, the market price can be used as a price oracle. And that's one of the ways that we've tried to cast the Microtick technology by calling it a price oracle. But as you can see, we're actually trying to do quite a bit more. We're actually trying to create a price discovery process that is unique and benefits from this decentralized technology that we're all part of. So given that we're using Schelling points, let's step back, and I don't want to bore everybody. You may know what a Schelling point is, but I'd like to cover it just in case people that are watching it, this is being recorded, and if people are watching it in the future, they can kind of get a basis of what we're talking about. A Schelling point is, in essence, cooperation without communication. It's based on the science of game theory, and basically all the participants that are in the marketplace, they base their actions at any given time based on what they think other participants are going to do. And in order to have that work, you must trust that the rules of the game are going to be enforced. An example of a Schelling point is a traffic light. Traffic lights work based on an expectation that drivers are going to act with the green signaling go and red signaling stop. With the light itself as being a smart contract, if the drivers don't trust that green is never going to be displayed in 2 crossing directions at any given time, it's not going to work. The trust breaks down. And designed into the system are slashing conditions. I mean, financial, you can get an expensive traffic ticket or worse. The way Microtick uses Schelling points are a given market. As you click onto the GUI, Microtick.zone is our GUI. If you click onto it and choose the market, all the participants participating in that market have the understanding that Bitcoin is what we're trying to do. We're representing Bitcoin in USD is the value that we're representing on that market. It's important to note that we're not actually trading Bitcoin in USD. We're just taking that price point and using that as a basis for our market action to work. Microtick can work on data series that are not prices. We've thought of many such examples. There's also examples of assets that are not particularly tradable. One of Kent's favorite examples is the price of real estate per square footage in New York City. If you wanted to arrive at a price on that, you can't actually trade it, but yet we can assign a value to it. And what Microtick is a way for a group of people to arrive at a consensus value for a volatile price over time and do that on a block by block basis. To do that, the trusted logic that we need to enforce are that for every block, all the quotes that exist on the market always sum up to a weighted average. And I've shown that there on the lower right. It's basically just each quote is based on the amount of backing and how tight the prices are. And we'll get into that in a little bit, but basically the more backing you supply and the tighter that your range is, that your certainty is when you supply the quote, the more weight you get in the market. So why did we use option pricing and not slashing based on reputation or slashing based on statistical averages or something like that? First, it's a natural fit. Blockchain sampling is inherently uncertain, as we covered in the previous slides. Prices vary in the real world. Blocks occur at uncertain times. Therefore, you can't say that the price at this block is this price. You can never say that. You need to say it's this price plus or minus a certain range. And that's the best you can really do. And what we're trying to do with option pricing is to give the most weight to the people that give the tightest estimate for that price range. Second reason to use options are that options are well known. Options exist in the financial markets. Options do not exist with short time frames in the financial markets. And that's where Microtick's unique pricing based on time duration instead of fixed strikes and expirations comes in handy, because we can accurately price options that go down to 5 minutes, 15 minutes, 1 hour, things that you traditionally don't see on a standard market. And that's because of several reasons, but it has to do with the order book volatility with short time frames. And it has to do with another slide that I'm going to be getting to here shortly. The fourth reason is that we can actually trade options. Microtick, because it's a price that changes over time, we can do a cash settlement between times and basically allow you to arbitrage with the real world market, even though you're not trading in the underlying asset. And we'll get into that in just a little bit too. So here's why we standardize with time durations instead of fixed expirations. Options, the premium versus time to expiry drops off radically the closer you get to expiration. So what that means is if you're sitting, this graph here is in days, but you can see that line, that last day, it's just dropping right off the map. And if you were to maintain quotes with fixed times and expirations that close to expiration, you would have to be adjusting your quotes all the time. And it becomes intractable when you're trying to do that efficiently. And that's why we used duration in the way that we're doing it with Microtick. And the way we do that is we use a financial asset called a price assertion. It's a bidirectional option quote. So the market maker gives the spot price. Spot price means the observed price, or the price that he's putting his backing behind. He backs it with token backing. And he takes a premium, he specifies a range. So you give a price, you give a range, and then you back it with token value. The price assertion is an offer basically on either a call or a put at the current consensus. Note that the consensus does not have to equal the quote spot price. We'll get into that here in a second too. and the makers are pricing volatility. So instead of trying to be long or short the underlying asset, they're trying to be as accurate as possible. And the makers that have the tightest volatility will get the buyers to trade against them first. And if you're in the business of selling volatility, you want to have the best price because you're going to be traded first. And so they're competing to be as tight as possible without being so tight that they're not profitable. And that's the trade-off that the makers are trying to do. In the meantime, the takers, they watch for the way that the consensus varies with respect to the real world. And based on their expectations, they can actually take advantage of price arbitrage between the synthetic microtick market and the actual asset in the real world. And I'm going to talk about that in a little bit as well. And as I mentioned, the weight for any given quote in the weighted average for Microtick is always the token backing divided by that accuracy range, the premium. So when we say premium here, we're talking about that plus or minus value that, that we surround the spot price by. So I've illustrated that here. What we've got on the left, we've got the Microtick consensus price varying over time. And we've got a quote that's been placed right at that spot price. And we've got a premium plus or minus. The same premium, it's the same value either up or down. And you can see that if that is traded against the market maker, the profitable region, the market maker makes money if the price, if that blue price stays within the range of that premium over the time frame of the option. If it goes into the red, either in the up or the down, the market maker loses money, but only if basically the trader will trade that as either a call or a put. And so it's directional. So if it gets traded as a call and it goes down, the market maker doesn't lose money in this area. It depends on the way that the trade was undertaken. And we'll get into that a little bit more too. It should make some more sense here as we get through a couple more slides. So the number one thing to note is that spots that market makers provide are not always at the consensus average price. And the big question is, what do we do about this? Now, traditional oracles or oracle pools will say, okay, so we'll collect them over an epoch, and we will then calculate a moving average and then a standard deviation, and then we'll slash the quotes that are above or below the standard deviation cutoff. And that's the way that we'll make it reputation based. And that's the way that we'll get our consensus price. And that's the way that we'll incentivize people to be as accurate as possible. Microtick doesn't work that way. Microtick uses option pricing because we're actually specifying these quotes as an option. We can use theoretical option pricing. And I'm not going to go into too much detail here. I know this is a lot of moving lines and everything, but basically at the center, you see the quoted spot, the vertical line there. And then you see the quoted premium, which is the yellow line that is horizontal, where those two blue lines intersect. And that is your quoted price, is where those two lines intersect, right at the center of the chart. As the consensus moves either to the left or to the right, and that's indicated by the vertical red line, we know through option pricing that we can adjust the price of the calls and puts based on how far the consensus is from the quoted spot. Microtick, because everything is at the money, we can make the linear approximation that we're either plus or minus 0.5 delta, which is that green dotted line. So we make the assumption that we're always going to be at a plus or minus 0.5 delta. And that way we can adjust quotes in real time as the consensus moves either above or below the quoted price position. So what that looks like, I've added some numbers here for a comparison. So suppose our consensus is at $100. Quote spot is at 102, and the market maker has specified a premium of plus or minus $4. After the adjustment, that quote is going to look like this. And it's basically a compromise. It takes the halfway position between the quoted spot and the consensus average, and then it uses the premium that the market maker has supplied to create a new profitable region that is actually a live market condition. And then we move that and adjust it so that it's with reference to the consensus. So in this case, because the market maker's price was $2 above the consensus, we take the halfway point and the call premium becomes $5 and the actual put premium becomes $3. So even though the market maker quoted plus or minus 4, we've adjusted it because he was too high. The consensus was low. We've taken kind of the split position. Let me go back. We've taken the halfway point and we've made a compromise position and created a new order book based on the movement of the consensus. And the market maker hasn't had to update his quote during that time frame. So it saves on bandwidth, but yet it's still fair because we're following that option theoretical pricing curve with the linear approximation. So what that leads to is as the consensus price is moving, we get quotes that are off balance. So in this case, we have quote number 1 has more put premium than it does call premium, versus quote number 2 there has more call premium than put premium. And you can see that they've both been adjusted in real time as the consensus, as the weight has affected both of them in real time. And so on a tick by tick, block by block basis, we can offer the traders the best value on the market going from left to right. And so as you look at that order book, your best deals are on the left-hand side, because as a trader, you want the price to move into the unprofitable region for the market maker. You want to buy the cheapest call or the cheapest put.
Mark, if I could just interrupt you here, we've already covered a fair bit of ground. Do you guys have any questions thus far about all this? It's definitely, you get into sort of insider baseball territory a little bit if you're not too familiar with options pricing, but kind of one fundamental thing to understand here is just how this real paradigm shift between an order book and the inside bids that Mark was describing, as opposed to how price discovery takes place in the Microtick environment. It's really kind of a big difference in terms of how you go about making markets and providing quotes and trading. Cool. Sounds like no questions so far. We'll have ample opportunity after the presentation here for more questions. Cool. Thanks, Mark.
Yeah, you bet. So as we're placing a trade as a trader using the GUI, and we'd like to improve the GUI. It's what's up there for now, but this is how it works. You can move your mouse cursor to the left or right to select your quantity, and as you do that, the horizontal tan dotted line moves slightly up or down based on the total price. So it's basically summing the price of all the quotes and then averaging that out over the quantity you've selected, and then quoting you a cost. So in this example, we've chosen to buy 0.37 Bitcoin, and our average premium is a rise of 57.46 over the next 5 minutes. And our total cost is going to be about 21 DAI. And so the height of the green bar shows the amount that the price is going to have to move in order for the trade to be profitable for you. So you're basically paying that premium, and it's going to cost you 21.5 DAI to do that. And the DAI cost is always the premium times the quantity. So what you're doing there is, because this is quoted over 5 minutes in this example, you're buying about 0.4 Bitcoin worth of price movement over 5 minutes, and it's going to cost you about 21 DAI. And actually, I think that was for an hour. So not a bad deal. I mean, instead of paying $4,000 and then taking the downside risk of Bitcoin moving against you over that time frame, you basically pay the premium, and then if it goes down, you don't lose anything. You've already paid the premium, but you have everything to gain. As if the price goes into the 2x region or the 3x region is shown there, for every 1x that it moves, you make what you put into the trade back. So if it goes to 2x, you're going to make 21 DAI because you get $42 back. If it goes to the 3x range, you're going to make about 63 DAI. And we've kind of reflected that on this slide. We've said, we've illustrated that the total cost is associated with the premium, and for every 1x price movement, the trade pays out the total cost of what you've put into it. And that's what the outcome visualizer is showing you on the GUI. And we'll get into that. I'll actually walk you through a trade here in a little bit. When there's a trade in progress, it looks like this. You have a shaded rectangle, which shows the height of the original premium that you paid. And in this case, you can see the price has risen. We're about 40% through the life of the trade. You can see that the vertical bar where the bar divides the future time versus the past time, it's about 40% through the life of the trade. And the price has moved about 1.5 times the premium that you've paid. And you can see there at the bottom, the cost of the trade was about 10.5, and the current value is at 15.5. So we made about $5 off of that price movement, about 20 minutes worth of price movement. So, and that's off of $10 invested. So that's a 50% return. I guess, can we stop here and just, if anybody has any questions, I can answer them. Okay. So the next slide shows how we create option-based synthetic positions, and we can use them to arbitrage against real-world markets. Basically, if you're an options trader, you already know this, but for those of you who aren't options traders, if you buy a long call and a short put at the same strike price, you end up with the identical profit and loss scenario is what you would get by purchasing the underlying asset. Now, what that means for Microtick is that even though we are not actually trading the asset, we can simulate trading the asset over the lifespan of the options by allowing you to take a synthetic long or short position based on the short-term options that we're offering and that we're standardizing and everybody's competing against each other with. So what that means is if the consensus price is below the real world price, you can buy at the consensus price and sell in the real world at the actual price, with the bet that over the hour or whatever the time frame is, over the hour of the option lifespan, you're betting that those prices will converge over that time frame. And also coincidentally, by doing that, you are actually arbitraging the two markets and causing Microtick to rise and causing the real world. You're actually selling into maybe a real world pump. And so you're actually stabilizing the real world price and then bringing the Microtick Oracle price up simultaneously. Big benefits to both markets. And we've kind of covered that on this slide. We've got the use cases are hedging, speculation, selling premium. If you're a market maker, what you want to do is you want to sell 5-minute, 1 hour, 15-minute calls, and you want to do it as often as possible. And you may win some, you may lose some. You're thinking of it like a casino would. You have, every slot machine pull, you're going to lose some. In fact, you're going to lose a jackpot every once in a while. But over time, if you're pricing your volatility accurately, you're going to make money as long as you don't allow your quotes to drift too far from the consensus. Because as we saw in the previous slides, the further you are from the consensus, the more that you are offset from the premiums, and your premiums in one direction get directed or get offset. And so the game as a market maker is you're continuously centering your quote, but you're letting it drift just enough so that you're right at your comfortable region, and that's when your signal is to readjust your quote. As a trader, this is probably the one killer feature of Microtick that it just doesn't exist anywhere else in the markets, is the fact that the Microtick price, because we're basing it on the average of quotes that are at various time durations. If you get a pump, and I've tried to illustrate this with the graph on the lower right, where we get a price pump over a very short time duration, and then the average lags. you're going to have a price difference between the market price and the lagging price that you can take advantage of even after the price pump happens. So how often have you been sitting there and you've watched the price pump up and you wish that you could take advantage of that movement? Well, you can, because if the Microtick average has been lagging that, you can jump in and trade after the fact and lock in that price difference, because as a mean reverting process, prices tend to revert back to the average. So if in the center of that graph, if I was to buy and sell, or sell the real world in red and buy the Microtick price in blue, lock in that price difference and then wait the time frame, and if it mean reverts and those two prices are the same in the future, I have now arbitraged between the two markets and I've profited. And the thing about taking a long and short position with arbitrage is you don't care whether it sells off or goes into another pump run in the future. As long as the two prices are closer together than when you did the arbitrage, you make a profit. We also hope that by being a price that's based on averages, we're going to have a more stable price for dApps and one that they can arbitrage against. So we think that that's another significant advantage. And to sum up, this is a feature comparison between the various price discovery methods that we've covered. And I'll leave it on this slide for a little bit while I open it up for questions before we go into the live demo. And I'll talk a little bit. The order book requires tokenization or some sort of tradable asset. It is tradable. It works as a price oracle if it's on chain, like a decentralized order book or DEX. It doesn't work very well with cross-chain liquidity, because you're always trying to do that. You would have to bring in every inside bid and ask and then somehow combine them across every different chain. And that's not going to be very efficient. And the last column, price insurance, that's actually tailored specifically for Microtick, because that's what an option is. You can buy a short-term option, and as long as you pay that premium, you're insured against adverse price movement. And if it goes against you, you don't lose any more than the premium. So that's something unique to Microtick. So yeah, I'll leave it here for a little bit. Kent, do you want to jump in with any thoughts? And let me get set with the demo here.
It looks like Raul has a question. He says, one person that observes prices in CoinMarketCap or CoinGecko could take advantage of the prices. Microtick gets prices from public sources. Can this person get the prices before Microtick gets the prices? Sort of, I think he's referring maybe to front running, basically the price feed, perhaps.
Certainly you could take that chance as a market maker if you wanted to. If you think the price is going to be going up, you can place your quote above the current price and be rewarded. If you're in the center of the profitable region, then you have gained the entire premium that you've sold. So that's actually to your advantage if you can accurately predict that. So yeah, if you don't do that, you can still profit, but you may not profit as much. But on the flip side, if it moves against you, you're going to lose a little bit more. So Microtick is always trying to incentivize you to be as close to the consensus with respect to your premium that you quote as possible. And as long as you're doing that in a way that reflects your price movement expectations and your risk tolerance, then you can do whatever you want, really.
Thanks for the question, Raul. Another thing I just want to highlight here, one of the things that excites me the most about the features we see on this slide is the cross-chain liquidity aspect. You know, Microtick from the start has always been really designed to be chain agnostic. And I think it's a little bit unique in terms of dApps that have that attribute. You know, of course, anybody can choose not to be a maximalist and build their dApp on multiple chains. But the idea of actually aggregating liquidity across chains is I think, unique to Microtick, thanks to the way, you know, we achieve price discovery and the way markets can aggregate around you know, a certain price feed or market. When you look ahead to the future, it's, you know, right now, of course, we're building on Cosmos, which has proven to be, I think, a wonderful decision. It's scalable, has a wonderful ecosystem and community. With IBC, it's going to become incredibly powerful. Eventually, with the advent of other chains that are scalable, ETH2 down the road, Cardano, we'll be able to build on those, and then effectively have you know, better markets, more liquid markets, by virtue of kind of combining these different chains. When I realized this was possible, it was kind of this light bulb moment, like, wow, you know, we kind of stumbled on something that's pretty powerful here. So, you know, nothing that is going to be immediately doable, but as more chains become scalable, we think you know, that this increasingly liquid market will be viable.
So to do that, just to point out, you need to use the same token on each of those chains. And so what we've tried to do with the upcoming token license is to give people a way to do that. If you take the same token and use it as backing across all these different cross-chain implementations, then you're going to have the benefits of this combined liquidity. And if that's the Microtick TICK token, then everybody benefits. And then as the token appreciates, everybody's benefiting as well. So that vote will be coming up tomorrow. I'd like to, everybody that listens to this, please do vote. We're excited about the license. I think it'll be good for the community, but it's obviously up to you how you want to vote. So from here, I'll move into a demo. Can you see that new screen?
Yes.
All right. So what we'll do is we'll sign into, I've got a ledger that's already open here. We'll sign into an account. Whoops. Sorry, I got out of sync. Let me unlock it again. Okay, so what we've got here, we're viewing the Bitcoin market. Microtick right now, it's a brand new chain. We've got two markets running. We've got Bitcoin, we've got Ethereum, and that's it. As the technology progresses and as we get into the IBC realm, Stargate, and things like that, we're going to be opening up many new markets, and that's going to be governed by governance. So the validators on the chain will have the say in what markets get open or what markets do not. And we like it that way. So the first thing is on the upper left-hand side, you can see that that's your selection where you choose the market that you're interested in. To the right of that, you've got the various time durations. I can zoom in and trade 5-minute options, 15-minute, 1 hour, 4 hour, and 12 hour. Underneath the time frame there is the relative weights for each time duration. And the reason that might be important to you is if you're trying to gauge how sensitive the price is to price movement. The more the mass is concentrated, or by mass I mean token weight, the more the token weights are concentrated at the shorter durations, you're going to tend to have a more sensitive price, versus if you've got most of your quotes at the 12 or 4 hour time duration, then you're going to tend to have a more stable price, because the person with a 12-hour quote is going to have a much wider range of premium, and he won't be adjusting his quote nearly as often as a market maker with a 5-minute quote. And so by comparing those quotes, we can see here that we've got most of our token mass at the 5-minute time duration, which means we've got a fairly sensitive price feed, and this price is going to track Bitcoin fairly closely. We've got on the right-hand side, you can see the current consensus price, the current token mass, which is 2,000 DAI, is backing all the quotes across all the time durations in this market. And the weight, the total weight, is just the sum of those numbers that you see on the left-hand side. The token mass is the total amount of die that's available to be won on the market currently. So if I, for example, hover over this time duration, I'm choosing my quantity, and you can see that that green number increases the further I get to the right. And you can see that what I was describing, where the line, the green bar, gets taller the more quantity I buy, and that's because the quotes cost more as I move off to the right. What it's doing is it's averaging the quantities across all the quotes, and then calculating your average premium. It does that down here too for puts. So as I click on one of those, you can see the buy call dialog comes up with the parameters I've chosen. And now this confusing thing in the center comes up, but I'm going to explain what that is. And basically that's just a visualizer so that you can try and visualize how, if the price moves with a certain shape, how much money you stand to make based on what you've selected. So because we've spent $17, 17 die on this trade, if the price moves into this region, you can see the purple dashed line there is right over the 2x time frame. And because of that, you can see that my payout, illustrated by the text underneath the consensus price there, is approximately double what my position cost was. And so all the price has to do is move up to there, and I've doubled my money. If I move up to the 3x, or if I have a really high price movement, this is a 6x movement, I would make 103 die off of 17 die over that hour trade. Because it's a call, if it moves down, you're not going to make anything. If it's below the consensus, you're basically, as a trader, choosing a direction. And so I can choose a call or a put, but once I choose that direction, I'm committed to it. So on the downside, I'll illustrate that. Choose your trade. Here you make money if it goes down. If the price really drops off, you're basically ensuring your price movement, and your profit there would be about 134 die. Or I'm sorry, your payout would be 168 die off of the 33 invested. And so the visualizer is meant to be a way to just see how close those calls, whether they're realistic or not. If you think there's no way the price is going to move up 5x and that's what you're depending on, this allows you to visualize what you're getting into before you actually click that buy button. So what I'm going to do is just illustrate. Let's go into the 5-minute time duration. And suppose I'm bullish. I think there's news coming out, and I think it's coming out real soon. And I'm willing to take a $5 position on it. Let's buy about 5 die worth of call movement. And I'm hoping that I'm going to move up in this area over the next 5 minutes. It may or may not, but let's suppose that that's what my projections are. I've got, I see that the price in the real world has moved up. Microtick hasn't reflected it yet. I think it's going to happen real quickly. Maybe that makes sense. So I'm going to go ahead and confirm that on my ledger device. It comes up, and I can't show you this part, but it's confirming all the different trade parameters. I sign the transaction. And we have a trade. So you can see that the consensus moved up just a little bit by doing that trade.
Mark, Nikki was wondering, is that a random walk to the settlement price?
Yeah, for the outcome visualizer, we just put a random walk in there so that you can just kind of visualize. It's not how the price will move. It's just a way for you to eyeball and make sure that what you're getting into makes intuitive sense to you. So the trade is actually going up. I was right. Look at that. So the value of this trade is already about 30% of what I put into it. I'm not at a profit yet because I'm not above the gray region there of the shaded rectangle that illustrates the premium I paid. But here I've already made 50% of my trade back. And this price is moving based on the contributions of everybody that's participating in the market. We've got market makers across all the different time durations contributing prices. And so because of that, the more backing that we have on the market, the harder it becomes to manipulate, because you would have to put in enough backing to move that moving average correspondingly. And that becomes more and more intractable especially when you consider that you have to do that across all the time durations that have quotes on them. This trade is not too bad. So I've made about 70% back. The trade is currently worth 5.6 die. It cost me 7.5, so I'm not profitable yet, but the trade's only halfway over. Fingers crossed. In the meantime, we've got a status page where you can see your token balance. You can see your current unrealized gains and losses, giving you your total account value. I can see a trade history, which takes you back through all your trades, and you can see I've been active. Let me actually click onto one of those. This was the first trade that I made, trade T1. This was back in July. You can see that the start time was 2:31. It ended at 3:31. It was a 1 hour trade. Didn't make any money on it. You can see the price went down even though I bought a call, but it is what it is. I mean, you make enough of them and hope to, there we go, we're profitable. So what's happened here is Bitcoin has risen from, I bought it at about 106.96, actually 106.95.7. And it's since then, the Microtick estimate has risen to 107.08. And because now the price is moving more than the premium I paid, I'm making a pretty good profit. So now I put in 7.5 die. The trade is currently worth 9.6 die. So I want it to keep going up. That's not bad for a 5-minute trade, especially because I'm insured against adverse price movement. If it would have dropped a corresponding amount, I would have only lost the premium.
Mark, maybe you should always trade live on these demos.
I know. I wish I could do this in real life.
Yeah.
It doesn't always work out this way. I'm actually happy about this.
Speaking of gains, Nikki is also wondering, is the upside a trader can win capped at the token mass on the call or put side?
Was that a question?
Yes.
Could you repeat it? I'm sorry.
Is the upside that a trader can win capped at the token mass on the call or put side?
Okay, so Microtick always shoots for about a 10x ratio. And the way that we do that is we calculate the quantity based on the token backing that the market maker puts in at a 10x ratio. So when you're buying premium, the max upside would be a target of 10x, but based on how that premium gets increased or decreased, it could be a little bit above or below that. But typically your max win is going to be about 10x of what you put in across all the time durations. So this is not a bad trade. We're going to see my current account value is 141 die. I started out with 137 or something, so I've made about 3.5 die. And trade's about to expire. Not bad for a 5-minute trade. This was I'll have to give presentations more often because I seem to have better luck.
And Mark,
So
could you explain for everyone? So as you see the thing ticks down, and then your trade expires, and then hopefully you actually have some gains. The settle button. What happens when the trade actually settles? Is the onus on the user to click that settle button, or does it happen automatically?
The Microtick, the way that it works is when you place a trade, a portion of that commission that you pay is reserved as a settle incentive. And so literally anybody could go into the market and settle a trade and collect that settle incentive. So you could settle it and make that back. The market maker could settle it. In this case, the market maker did because I didn't do it. Or someone else on the market could jump in and just make money from seeing trades that have expired but not settled yet, and just issue transactions and collect the incentive.
Yeah, pretty clever way to incentivize the settlement. Raul is wondering how often the price feed is updated in seconds.
The price, that's a hard question to answer. I mean, It's based on the market participants and how sensitive they are to price changes. If you're a market maker and you're very sensitive to price changes, and you're in the 5-minute or 15-minute time range, you're going to be updating your quote quite often. But if you're trading in the 4 or 12-hour time window, there's times when you don't have to update your quote's price for an entire day. So it is completely dependent on price conditions, and that's probably also indicated by these quantities that are below the time frames. If you see that the market has more 5-minute wait than it does 12-hour wait, it's probably going to update more frequently. Not guaranteed, but it depends on the real world condition too. If Bitcoin isn't moving, nobody's going to be updating their price anyway.
Nikki's wondering, is it possible to somehow close a trade midway through the time window, or do they always run to the expiry? It's the latter. Correct me if I'm wrong, Mark. I believe there's nothing magic about the way we've implemented this. We could have the option to close out a trade. Let's say, okay, I'm up 10%. I'm going to get out now. But currently, you're in for the duration of the time frame.
Currently, you're in for the duration. These are not American style options. We do have an option in the parameters that enables American style where you can trade early exercise like that. However, the full disclosure, the logic isn't implemented yet, so that won't work. That's one of the things that I'd like to get in there as soon as possible.
Cool.
Another thing to discuss is the way that you fund the account. Currently, we have a KYC bridge, which assigns a unique Ethereum address to your Cosmos address, and it's a shapeshift KYC process. And we've had a lot of people reporting that they don't want to go through that. So one of the things that we're looking forward to is to enabling IBC with our marketplace. But for right now, this is the way you get on and off the chain. If you're a validator, you can also use this mechanism to withdraw your DAI profits. You can withdraw using your ledger or your same account, and you can choose the amount. There's a minimum due to ETH gas costs, but anything between 10 and 500 DAI, you can just withdraw.
One thing worth mentioning here as we look at the UI and UX is, this is it's a usable interface, especially once you understand some of the functionality. But it's very much like a first iteration. Microtick will likely have, some abstraction built in. One thing that we think could be especially powerful would be like the use of community bounties to incentivize, somebody that is really a specialist with UI to jump in there and change things around. There's definitely ways to abstract things away and it may be in a way that would favor less advanced traders, people that simply want to, take a position. Okay, what's the time frame, up or down? It doesn't necessarily have to be presenting this much information. So it's likely that over time, in the not too distant future, we'll see different, different variations of this, and really owing to the open source nature of the project and the fact it's built on a decentralized blockchain, should make that more feasible.
Oh yeah, and Microtick does not intend to be the only onboard or only source for a GUI for this. It's an open chain, and everybody knows how to connect to it. And so if you have a better idea for a GUI, put it up there, by all means. If this governance proposal that starts tomorrow passes, we will be open sourcing the GUI in addition to the node. So you'll be able to take all that code and modify it, put your own logo on it as you want to. We see this technology as being innovative enough that we want to get it out there and put it in front of the community and let people innovate, but yet we want to tie it to the tick token so that people that are involved early have an incentive for staying involved and just generating a critical mass that way, as opposed to trying to keep something closed source or just being the sole source of a trading GUI. We want this to be very much a community effort. So if there's no other questions, I mean, that's kind of what I had for the demo in the walkthrough. I hope it was helpful for people. Thank you for joining us. And if you have questions in the future, if you're watching this on a recorded video stream, jump on our Telegram. It's linked to from microtick.com, and you can ask questions there. You can also join our Discord, which is also linked to from the Telegram. So thank you.
Yeah, thanks, guys. Seriously, anytime you have questions about anything, please hop in Discord or Telegram. And also, if you have any ideas, this is a community we're collectively building here. So, thoughts, feedback, ideas on how to do something unique or improve the ecosystem is always welcome. So we'll see you out there in the cosmos. Thank you.